Next, financial viability of a project. In TV report, this aspect will also be addressed. Why? Because the ultimate objective when loan is sanctioned is it should be repaid. Okay. So how it is going to be repaid? It will be repaid out of profits, or let's say cash profits of the business. So if you want to ensure that loan is repaid, you should give correct amount of loan, and that depends upon project, let's say debt equity ratio, because banks will not go beyond a particular level of debt equity ratio. Okay, so debt equity ratio plays very important role in fixing what is going to be the loan amount. If the bank has a policy that it will not go beyond debt equity ratio of 2:1, then bank will sanction only 2/3 of the project cost as a loan, right? It means 2/3 of the cost of project is coming here as loan. So look, everything is now linked to what? Cost of project. So unless this cost of project is accurate, then I think if this is not accurate, everything will be a mess here, because you are going to give a loan against inaccurate cost of project. It means the cost is wrong, loan is high, and it will not get repaid because you have inflated cost, but you cannot have inflated cash profit. Cash profit will be actual. So this is going to affect the repayment of the loan. Okay, so that's why accuracy of cost estimates is very important, and this will be taken care at TEV report level itself, because the consultants, they'll be going through the estimates, or say quotations, or let's say the pro forma invoices submitted by the borrower, and they'll give a certification that let's say the cost are reasonable, and they'll also check what is the similar price range. They'll also check what is the similar price range. Okay, and they'll see whether the cost is reasonable. That's more important, and they'll also do cross check with other suppliers. Okay, other suppliers, and by all this we get to know whether the cost estimates are accurate. Okay, so if that is taken care in TV report, that can be brought out in the proposal also, or it should be brought out. And if it is not addressed in the TV report, you should take up with those consultants to certify on the accuracy of cost estimates also. Okay, because you do not know exactly whether this is going to be the cost for some X machine or Y machine. Only those consultants who are technically competent, they'll be able to certify on that. Next, the TV report will also comment on suitability of financing pattern. Okay, that is how this project is going to be funded, because the project can be funded in combination of debt and equity. Fine. So how much is going to come from equity, how much is going to come from debt, and within equity what are the distribution patterns? I mean equity in the sense, this is the contribution, right? So how much is going to come from share capital, how much is going to come from internal accruals, how much is going to come from preference share capital, all those. And in debt, how much is from term loan from your bank, term loan from other bank, are they raising any debentures, are they raising any unsecured loan, and whether this financing pattern is okay. Because let's say they come with a proposal saying that debt should be 75% and equity should be 25%, making the debt equity ratio as 3:1, then if they feel, they may say that this 3:1 is not a viable proposition, because 75% debt means this is going to add lot of risk to the company. This is going to result in credit risk. Why? Because this project is not that competent, or this project is not that capable enough to generate so much of cash to service this loan. So this project may attract a default risk. Okay, so they are going to talk about the suitability of financing pattern. So they'll say that no, it cannot be in the range of 3:1. It should be brought down to 2:1. That is 67% of debt and 33% of equity, because only at this level they are having repayment capacity. Okay, then they'll also be talking about the soundness of capital structure. Okay, fine, they have decided, I mean the borrower has decided to part fund this project, and how they are planning for that: 1 share capital, 2 internal accrual, 3 preference share capital. Okay, share capital, okay, fine, this directly goes to TNW. Okay, but they may have some kind of reservations on internal accruals, because internal accruals are not something which is dedicated for funding projects. Internal accruals has various roles. Internal accruals have to be used for distributing dividend. Internal accruals have to be used for supporting working capital margin, net working capital. Okay, so if they feel that internal accruals are not adequate enough, they'll say the capital structure what is proposed is not sound. Okay, because internal accruals are not adequate enough, and sometimes they'll even say preference share capital is not appropriate at this stage. Company should raise equity share capital only, because this is also going to have some kind of a fixed cost. Okay, where the company is already having a lot of fixed cost, adding another fixed cost is not going to help. The capital structure is not sound. Okay, so all those aspects will be addressed at the financial viability stage, and wherever the negative observations are recorded by the consultants, that should be discussed in the proposal, so that sanctioning authority will understand what are the key points that are brought out by external or say bank's own consultants.
Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2000 rupees. But for you, I'm going to give you a special offer.
Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2, that is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far I have introduced 7 courses of 1999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.